In 2016, Warren Buffett, the man who famously avoided tech stocks his entire career, quietly started buying shares of a company. By 2023, that single bet had grown to over $36 billion invested, and a position worth nearly $180 billion. The company? Apple. The same man who said he didn't understand tech. The same man who passed on Amazon, Google, and Microsoft. So what did Buffett see in Apple that he missed in everyone else? Today, we're going inside one of the greatest investment decisions of all time, and what it reveals about how the world's greatest investor really thinks about money. To understand why this investment is so stunning, you have to understand Warren Buffett's history with technology. For decades, through the dot-com boom, through the rise of Google, through the birth of social media, Buffett sat on the sidelines. His reasoning was simple. He didn't invest in things he couldn't understand. He called it his circle of competence. If a business was too complex, too unpredictable, too dependent on technological shifts, he passed. He watched Amazon turn retail upside down. He watched Google print money from search ads. He watched Netflix reshape entertainment. And he did nothing. He even openly admitted it, calling his decision to not buy Google and Amazon a mistake. So when Buffett started buying Apple in early 2016, the investing world took notice. Something had changed. But what? Here's the key insight, and this is the most important thing you'll hear in this video. Buffett didn't buy Apple as a tech stock. He bought it as a consumer brand. In his own words, "It's probably the best business I know in the world." Not the best tech company. The best business. Think about what Apple actually is. Yes, it makes iPhones and MacBooks. But what it really sells is an ecosystem, a locked-in, deeply emotional relationship with its customers. iPhone users don't just use iPhones. They use iMessage, FaceTime, AirPods, Apple Watch, iCloud, Apple Pay, the App Store. Every product feeds every other product. Buffett calls this a moat, a competitive advantage that's almost impossible to break down. And Apple's moat isn't just technology. It's habit, identity, loyalty. He once used this example. If someone offered iPhone users $10,000 to permanently switch to Android, most would refuse. That's not a tech company. That's a religion. Now let's talk about the cold, hard numbers, because this is where Buffett's investment brain really lit up. When Berkshire started buying Apple in 2016, the stock was trading at around $25 to $28 per share, adjusted for splits. The market was oddly lukewarm on Apple at the time, growth had slowed, and people were worried the iPhone had peaked. But Buffett saw something else. He saw mobile phone massive free cash flow. Apple was generating tens of billions in cash every single year, money it didn't even know what to do with. Repeat button aggressive share buybacks. Apple was buying back its own stock at an enormous pace, which means Berkshire's ownership percentage kept growing even without buying more shares. Bar chart pricing power. Apple raised iPhone prices year after year, and customers kept paying. That's the definition of a business with real power over its market. Globe showing Europe-Africa global scale. Over 1 billion active Apple devices worldwide. And still growing in markets like India and Southeast Asia. Buffett's partner Charlie Munger called Apple the luckiest investment Berkshire ever made. But luck had nothing to do with it. This was pattern recognition at the highest level. Here's something most people completely miss about why Buffett loves Apple so much, and it has nothing to do with the iPhone. It's about share buybacks. Here's how it works. When Apple buys back its own shares from the market, there are fewer shares outstanding. So every remaining shareholder automatically owns a bigger slice of the company, without spending a single extra dollar. Buffett has talked about this publicly. He said something like, "I love it when Apple buys back shares. We own more of a wonderful business every quarter without doing anything." Between 2018 and 2023, Apple spent over $500 billion buying back its own stock. That's more than any company in history. Berkshire started with roughly 5.4% ownership of Apple. Without buying a single new share for years, that ownership percentage has quietly crept higher, just because Apple keeps shrinking the total share count. This is compounding at its most elegant. Buffett didn't just buy a great business. He bought a great business that was automatically making him richer over time. Now here's where it gets interesting. In 2024, Buffett made headlines by trimming his Apple position, selling roughly half his holdings. Berkshire's Apple stake went from about 900 million shares to around 400 million. The internet went wild. "Buffett is abandoning Apple," the headlines screamed. But read between the lines. Even after those sales, Apple remains by far Berkshire's largest single holding, representing around 25 to 30% of the entire portfolio. Why did he sell? Likely a combination of reasons. Tax strategy. Capital gains taxes were expected to rise, so locking in gains at lower rates made financial sense. Cash accumulation. Berkshire's cash pile hit a record $325 billion. Buffett was preparing for a big opportunity, or simply being cautious in an expensive market. Valuation discipline. At its peak, Apple was trading at 35x earnings. Even Buffett knows when a stock has priced in a lot of optimism. But he didn't exit. He trimmed. There's a massive difference. Holding $80+ billion in a single stock isn't doubt. It's conviction. So what can we actually learn from this? Lesson 1: Buy businesses, not stocks. Buffett doesn't think about tickers and charts. He thinks about whether he'd want to own the entire business for the next 20 years. Ask yourself that question before every investment. Lesson 2: Moats matter more than growth. Apple's revenue growth in 2016 was actually slowing. But the moat, the ecosystem, the loyalty, the switching costs, was stronger than ever. Learn to see that difference. Lesson 3: Understand what you own. Buffett didn't see Apple as tech. He saw it as the world's greatest consumer brand, something he deeply understood from decades of studying Coca-Cola, See's Candies, and American Express. Frame your investments through lenses you actually understand. Lesson 4: Let compounding do the work. Buffett bought Apple and largely sat still. He didn't trade in and out. He didn't react to every earnings call. He let time, buybacks, and Apple's own business excellence build his wealth for him. Lesson 5: Be willing to change your mind. Buffett avoided tech for 40 years, and then recognized when his thinking was incomplete. The greatest investors aren't rigid. They evolve. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." His Apple investment is the ultimate proof of that. He bought when others were nervous. He held when others panicked. He trimmed when others were euphoric. And through it all, he kept asking one question: is this still a great business? As long as the answer is yes, he holds. That's not a strategy. That's a philosophy. And it's one that's made him the greatest investor who ever lived. If you found this video valuable, smash that like button and subscribe. We break down the world's most powerful investing decisions every week, in plain English. Drop a comment below. Would you have had the conviction to hold Apple through all its ups and downs? See you in the next one.